Okay, so now moving on to chapter 10, which we're going to talk about receivables and bad debt. Okay, now if you remember, receivables is a means to, you know, collect money that our customers owe us, right? So, what are receivables? Receivables is going to be when customers owe you money on an account, which, right? So, when you sell a good or service, right, you allow your customers to pay you later. They get the product and services right now, but you allow them to owe you and pay you back later. Okay. Now, here's a few things about that, knowing and understanding what happens when you do end up allowing your customers, right, to owe you on an account. Because this is where I'm going to be introducing you to the allowance for doubtful accounts. Now, with that, right, you have to understand that there is risk to allowing your customers to owe you money, especially because, again, you may never know the given situation that your customer may have. You don't know what their financial you know, stability is. You don't know what there's going on in their life. You don't know what's going on. You know, things like, you know, a pandemic, right? You don't know how you know, a customer can you know, not have enough money to make those payments on time. Okay, so this is where the allowance for doubtful accounts is going to come into play, where we're going to be introducing, well, if you allow them to owe you on an account, right? Excuse me, and for some reason, whoa, and for some reason, they either file for bankruptcy, they just don't have enough money to pay, or they promise to pay you like later, or they call in and say, I'm sorry, I'm unable to make a payment. For some reason that they are choosing to not make a payment, right? You know exactly who, you know exactly when, and you know exactly how much, right? So for instance, right, you notice that this one person isn't paying me, and you have to contact them or send them a letter saying, hey, what's going on? We want to know what your situation is, but you missed your payment. Okay? So you're obviously going to know who, all right? And you're obviously going to know how much that they owe you, because you're going to be looking at their account balance and saying, wow, you owe me this much money. And because you're sending your, you know, usually when you allow your customers to owe you on an account, usually you give them about 30, 60 days to make a payment, or you could choose to make a payment plan with them. All right. So then that means, you know, you keep track of with your customers, right? So at the end of the day, you'll know exactly when the customer chooses not to either pay, or they forgot to pay, or, you know, they're just not paying in general. Okay? And that's where we're going to be using the allowance for doubtful accounts, which is a contra account to accounts receivable. Okay? Think of it as a placeholder account, right? You have the money that they owe you, but because, you know, they're showing signs and tendencies that they're not making a payment, or they failed to pay, right? You need to kind of separate them, because again, it becomes potential bad debt. And that's what the allowance for doubtful accounts is that it's an account that you're going to separate this account receivable, and you're going to plug it into the allowance for doubtful accounts, because this person may or may not pay. And you don't want to hold on to that, especially if, you know, you have, this person, like, they miss their payments and they keep missing, and you keep, notifying them that they're missing their payment, and they choose to not pay at all. You don't want to keep that debt that they owe to be in your books, right? Because that right there, you can already assume it's a loss. Okay? So what do I mean by doing this? So let's see. When we do allow our customers to owe us on an account, so for example, December 15, we sold to Robert toys, right? We sold $100 worth of toys on an account, okay? And he's gonna make monthly payments of $20, okay? Okay, starting January, right? And so then on March 20th, right, he files for bankruptcy, and then the debt collector lets you know that he can no longer pay anymore or make his payments anymore. So here's a few things we gotta recognize. We gotta recognize that first off, in December, we allowed him to owe us on an account, right? We sold him some toys for $100, okay? January, he makes a payment of $20. February, he makes a payment of $20. And then March, he decides to file for bankruptcy. So in this case, he's only made a payment of $40. So that means he still owes me $60, right? So because he decides to file for bankruptcy and the debt collector told us that this person is no longer going to be able to make their payments, that means that's a $60 loss that I'm going to take because he can't pay me anymore, right? So therefore, I'm going to take that $60 that he owes me on an account receivable, and I'm going to move it into the allowance for doubtful accounts account, okay? Because this is potential bad debt, okay? And when I say potential bad debt, just because he filed for bankruptcy, that doesn't necessarily mean we can no longer collect money from him, right? We always have a possibility that we can still collect money from Robert in the future, okay? So then that's what you do, okay? Now let me introduce you to what bad debt does. Now, once you reach the end of the accounting period, right, and you're tallying up your totals and you notice that, that this is the amount of money that a lot of people owe you. But realistically, out of all of those people who owe you, there is that still possibility that you're going to have someone that faults on their payment. Now, in this case, will you know who? Will you know when? And will you know how much? No, you won't, because again, you can't determine someone's financial circumstances until it actually hits them, right? But what the IRS allows you to do is they allow you to actually take 5% off and write off as a loss, right? With no penalties. So in this case, the IRS allows you to make the assumption that realistically 5% of your customers are not going to make their payment because of any given situations, right? They can lose their job at any moment. They can, file for bankruptcy at any minute, right? We cannot determine. However, that means we need to assume that out of all of my customers, right, at least 5% of what they owe me is going to be will be a loss, okay? Because I don't know who and I don't know when. It's not your job to keep track of every single customer and know every details in what their financial circumstances are. You're not going to be keeping track of John and saying, oh, hey, John, how's your job, right? That's not your job. Your job is to sell a product and service, and your job is just to collect the money. And if John decides to say, I can't make a payment, then that's where you're going to go ahead and make the assumption that you are, make the conclusion that you can write them off as a bad debt. But in this case, I don't know. I don't know if John's going to pay me or not. So that's where the bad debt expense account is going to come into play. It is an adjustment to the it is an adjustment entry, so meaning it only happens at the end of the giving accounting period. Usually, typically, this happens at the end of the year because usually, give or take, you can't really determine someone not making their payment based on the month. Usually, you would give them a span of 6 to even a year. If this person is showing tendencies of them missing their payment, let's say as of March, and you sent them notifications, fast forward, it's October, and you sent them notifications, you called them, you emailed them, you sent them many statements and many late charges, and you even contact them and trying to see what's going on, then you can go ahead and safely say, okay, they're not going to pay me back. But in this case, right, what the bad debt expense does is it gives you an allowance for you to be able to make a rough estimate of out of the total people, right? John could be one of those people who could fall under payments, right? Anybody could be able to miss their payment, right? So in this case, what bad debt does is it allows you to do a rough estimate. So in this case, right, most cases, it's going to about be roughly 5% of your accounts receivable. So that's what the cap is going to be about. It's about 5%. So again, this is, if it's less than that, then it's less than that. But if you want to use 5%, you can use 5%. Because that's what the annual percentage that the IRS allows you to write off as bad debt, okay? And of course, that way you take that 5% of what of total amount that people owe you to determine an amount, and then of course you'll never know when, okay? Because you never know when these people are not going to make their payments on time, and you don't know who. So at the end of the day, this is going to be a rough estimate because again, because you don't know who, you don't know how much each person is not going to pay you, and you don't know when it's going to happen. So that's the key feature of understanding the difference between using the allowance for doubtful accounts and then using the bad debt expense. The allowance for doubtful accounts happens during the accounting period, right? So again, that situation with Robert, right? It just happened randomly and we recorded it. However, this right here for the bad debt expense, it happens towards the end of the accounting period, okay? Usually, like I mentioned before, right, it's usually determined at the end of the year. It's kind of hard to determine on a month-to-month basis, okay? Now, how do we journalize the bad debt? So there are two ways that we can journalize the bad debt, okay? The first one is called the direct write-off method, okay, which is used for tax purposes only, and it's used for the IRS where they're going to directly take off the bad debt directly out from the accounts receivable, okay? And then there's the allowance method, which is governed by GAAP, and it's used for the regular accountant, okay? So that means, in this case, are we the tax accountant or are we just the general accountant? Right? This isn't a tax class, right? You need to have the general accountant knowledge before you can even talk about tax. So in this case, we are not going to teach you to use the direct write-off method because you're not the tax accountant, okay? However, you do need to know this for one most, okay? The direct write-off method is a method that we use to write off bad debt, but it is for tax purposes only. But what you need to know is you need to know the allowance method, which breaks into two more ways that you can journalize this, okay? The balance sheet way, the balance sheet method, and then the income statement method, okay? So again, we are not going to be doing the direct write-off. We're going to be only focusing on the allowance method, okay? So since there's two methods of the allowance method, right, let's break down one method at a time. So let's use the balance sheet method, okay? Now in this case, right, here's a scenario where we have a potential bad debt. It is estimated that 25,000 of its 500,000 accounts receivable is to be uncollectible, okay? And there's currently a debit balance in the of $5,000 in the allowance for doubtful accounts, okay? So, now that we know that much information, right? Now let's determine this. How do I tell that this is going to be the balance sheet method? Well, here's a few things that you need to look for. When you read this, here's a few things that you need to know. So up here in the right corner, you need to keep a note of what you're reading. So in this case, what is this estimated amount of? Is it of an account receivable? In this case, yes, it is. It is $5,000 of $25,000 of a 500,000 accounts receivable, okay? Once you determine that, then you know it's the balance sheet method, right? Because why? On the balance sheet, you are going to have the accounts of accounts receivable on there and the allowance or doubtful accounts. That appears on the balance sheet. That's how you know you're going to be using the balance sheet method. Now, what does the balance sheet method do? Well, now that you determined the balance sheet method, here's what you need. You need the estimated amount of $25,000, okay? Not your overall amount. You're looking at your estimated amount of $25,000, okay? Good. The next thing is, do you have an account balance to your allowance for doubtful accounts? If you remember, the allowance for doubtful accounts is a contra account, okay? Meaning it's opposite. It flows in the opposite direction as the main account, which is your accounts receivable. But it depends on whether you have a debit or a credit. So in this case, right, if you have a debit balance, meaning you're on the left side, right, you need to get to a total credit of $25,000, okay, because the allowance method is essentially, once again, it is the contra account to accounts receivable. So in this case, if I currently have right now $5,000 on the debit side, I need to get to $25,000 on the credit side, okay? Where does this balance come from? It comes from when we were journalizing during the accounting period, right? If you remember the Robert situation, we end up debiting the allowance for doubtful accounts, right? That's where this money came from, okay? So in this case, right, I currently have a debit balance. If I'm on the left 5,000 and I need to be on the right for 25,000, right? How much do you need to credit your account to get to a total of 25,000? Okay? So think of it like a number line, right? You got your positive, you got zero, and you got your negative, right? If you're on the positive side, how do I get all the way to the negative side? Well, how many steps does it get to from the positive side to zero, right? In this case, it's 5,000, right? And then how many more do I need to go to get all the way to the negative side? I need to add 25,000. So that's the rule here. When you notice that you have a debit balance in the allowance for doubtful accounts, you just add those two numbers together. So in this case, you're going to add 25,000 plus, which is your estimated amount, plus your balance of 5,000, okay? And that's going to give you $30,000 that you need to journalize, which is you're going to journalize your bad debt expense and you're going to credit your allowance for doubtful accounts, okay? All right, so that's example number 1. Let's try example number 2, okay? This time, right, you have a total of the estimated amount of 25,000 of your 500,000 of accounts receivable to be uncollectible. Okay? This time you have a credit balance of $5,000 in the allowance for doubtful accounts. Okay? So this time, instead of having a debit balance, I have a credit balance of $5,000. So I'm already on the I'm already on the right side, right? I need to continue going to the right side to 25,000. So right now I'm at 5,000. How many more do I need to go more right to get to 25,000? And that's the idea here. You're going to take the estimated amount and you're going to subtract 5,000 because you already are on the right side by 5,000. How many more do you need to get to 25,000? So you subtract those two numbers and you're going to get 20,000. Okay? Any questions? No questions?
No.
Okay. So then now let's go ahead and talk about the income statement method. Okay? What makes the income statement different than the balance statement method? Well, let's take a look. Let's read the scenario. It is estimated that 25,000 of 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. So notice this, right? The keyword that we're looking for here is total credit sales. Why? Well, let's take a look at our income statement. The income statement is going to show you your total sales, right? In this case, it gives me my cash sales, it gives me my total credit sales. Nowhere on the income statement will you see allowance for doubtful accounts or accounts receivable. It does not appear. Okay? So therefore, you need to determine this, right? Since the allowance for doubtful accounts and the accounts receivable does not appear, and you're looking at total credit sales, that's how you know you're going to be using the income statement method. Okay? Now, what does the income statement method do? Well, it's the easiest one because all you need to do is recognize how much your estimate is. In this case, right here, your estimate amount is 25,000, right? And that's all you have to do because that's it. It's just 25,000. Why? Because you're using the income statement method. Since we said that the allowance for doubtful accounts does not appear, we can disregard. We don't care about this $5,000 because it doesn't affect me at all because I'm not using the balance sheet. I'm using the income statement method, which only tells me what my total credit sales is. So in this case, I just look for that keyword. I look for the estimate, 25,000, boom, okay? So once again, scenario number 2. What if I have the same scenario except this time I have a credit balance of $5,000? In this case, I don't care because all I care about is what my estimated number is. Okay? All right, course review. So we talked about how receivables work, right? We talked about how when you allow your customers to owe you money, then it becomes an accounts receivable. And then we talked about what happens during the accounting period when your customers start faulting on their payments during the course of the year. Okay, so again, you're going to be using the allowance for doubtful accounts for that. Okay. However, right, once you reach the end of the year or the end of the accounting period, you're going to come to a conclusion where realistically, not all of your customers are actually going to pay you. So this is where the bad debt expense is going to come into play, where you don't know who and you don't know when, and you don't know exactly how much people are going to foot on their payment, you're going to create a rough estimate. Okay? So here, right, we talked about the two methods, which is the direct write-off method and the allowance method, right? I'm not gonna show you how to do the direct write-off because it's for tax purposes only. We did learn about the allowance method, right? It's broken down into the balance sheet and the income statement method, which is broken down right here, right? Balance sheet, we need to determine the estimated number, the account receivable, and the balance in the allowance or doubtful accounts. If it's a debit, you add. If it's a credit, you subtract. Whereas the income statement, all you're really looking for is the estimated amount and total credit sales. Okay? And this is how you journalize them. Okay? So let's go quickly over our exercise. Okay? So here we are, chapter 10.1 exercise. Okay? So question number 1. Right, December 15. Okay, Robert buys a total of 100 coffee mugs for $9.99 each, and on an account, sales tax is 8.25%. So how do I journalize that I sold a total of 100 coffee mugs for $9.99 each on an account?
Coffee mug.
No. We're looking at a sale here, right? We do sales. How did Robert pay?
On an account.
On an account. So what account are we going to use?
Payable.
Not payable. That's when we owe money.
Receivable.
Receivable. Good. So,
Account receivable.
right, we just made a sale and we need to include sales tax. So in this case, I just sold 100 coffee mugs at $9.99 each. So what's my total sales here?
109. 999.
$999 and I think it's 90 cents. No.
I got just 3 nines.
Okay. How much is tax?
The tax 8.25 is gonna be 999. So now it's 999, 8.25. 8,233,508.
You're telling me tax is going to be $8,000.
So we do 999, correct?
Mm-hmm.
By
Times. Good.
8.25, correct?
Is that percent or decimal?
Decimal.
No, it's 0.0825.
So I got 8,24175, like 825. 824.
Why would tax be $824?
So now after the 3 9s,
You're going to
by
multiply by 0.0825. It's a decimal, not you're not looking at percentage, right?
8,
No, 0.0825.
0.0825. Yeah, it's coming 8. I'm not sure why. How do we-
42.
It's only $82.42. So what's the total amount that Robert owes me?
The total is gonna be
1,081.42.
$1,081.42. Okay. Then I'm gonna make a note here that you sold okay. So then on January 15, Robert sends a check for $25. Robert sends a check for $25.
So we need to do minus from 1,000.
No. What is the transaction on hand?
Check.
Okay, you received a check, right? How much was the check for?
Receivable.
How much was the check for?
25 $.
Okay, and you said account receivable, right? Yes, you're decreasing what he owes you. Okay, you're not calculating it right now. This isn't the ledger. This is just recording that you received a payment, that he's paying for what he's owed. So in this case, received payment from Robert. Okay. On February 15, Robert informs you that he can no longer pay due to his financial circumstances. So what happened here? Robert can't pay you anymore. So what does that mean?
Bad debt.
Not bad debt. It's not the end of the accounting. It's not the end of the year yet. And you know exactly who owed you the money. You know Robert owed you the money, right? And he's not making a payment. What was the first thing I taught you before the bad debt? It's a contra account. Anybody?
allowance.
Allowance for doubtful accounts.
Mm-hmm.
Okay? Because you know exactly who, right? Now, in this case, the allowance for doubtful accounts, right? Remember, it's like a placeholder account, right? If you actually look at it in a real life term, right? If he's not paying for the stuff that he owes, you're gonna freeze his account, right? You're gonna freeze his account. So how do you freeze his account? You gotta put it into a placeholder account called the allowance for doubtful accounts, and you're gonna remove that from the accounts receivable. Because remember, the accounts receivable account includes everybody that owes you money. So in this case, you're only singling out Robert, and you're going to freeze his account. Okay? 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 So in this case, how much does Robert owe me? How much does Robert owe me right now?
We got the 1,000. We minus 25 from this.
Mm-hmm.
Okay. 1,000. Okay. Eight, one, minus 25. To give me 1,056.42.
Okay? So that is how much Robert owes me. Okay? So then on June 15, Robert says that he can pay $25 this month, okay, and sends you a check. Okay? June 15, so a couple months later.
So, do we charge him for he being late or not?
In this case, we're ignoring that.
So now we're gonna be like minus the another $25.
What is the transaction at hand right now?
It's account payable
No, not accounts payable.
because he pay us.
He paid
Then
us.
check.
Receivable.
Okay. Now, in this case, can we actually take it out of the accounts receivable?
Is check.
No, because we froze the account.
No, because we froze the account. So what do we have to do?
Send him back.
No. If we froze his account, what do we need to do? If he just paid me and I froze his account,
Deactivate the account.
we need to reactivate the account. How do you reactivate the account? If I deactivated him here, how do I undo that?
Allowance. Okay. Can we say allowance?
We're undoing this, right? So right now we froze his account. We need to unfreeze it.
Okay.
So that means we got to put the money back into the account receivable.
Account receivable. Check.
Not yet. Because right now his account's frozen. How can we say that there's account activity if his account's frozen?
Could we say check received?
Okay. Listen, you're missing a step here. My account right now is frozen. I need to unfreeze it first. You're not listening. Listen, my account's frozen right now. I need I have to activate it first before I can receive the check. So right now, I'm currently working on reactivating his account.
Could we say like activate his account for?
Well, right now we're not focusing on the description. We're focusing on the account. So how do I unfreeze his account?
Checking account?
No. Right now, my account's frozen, right? I froze his account by removing his amount from the accounts receivable and putting it into a placeholder account. I froze his account. Now I need to undo it. How do I undo this transaction?
Oh, we put it back like inside.
Yes.
Yeah.
Yes. So in this case, I am reactivating his account. I have to put the money back into the account to say, okay, now he owes me money. Because right now, it's saying that he doesn't owe me money. He is in debt to me. He's going to default on his payment. So now, he's paid me back. He's paid me again. I need to take that amount and put it back into the account receivable because now I am unfreezing his account. Okay. So in this case, if I'm unfreezing his account, how much am I going to unfreeze it for?
1,056.42.
Right, because we're assuming that, hey, he's starting to make up his payments again. So that means I'm going to activate his entire account for the 1056.42 because I can't predict that he's not going to make a payment next week or the month after. I'm saying it's an opportunity. We might get all $1,000 back. So in this case, I need to put this money back in here. Okay? And then I'm going to go ahead and say to add back account Robert's accounts receivable balance. Okay? And then now I can go ahead and receive the payment. So in this case, I received a payment. I received a payment for $25. So how am I going to journalize this?
Account receivable.
Accounts receivable is going to be second. What should be the first thing I should recognize?
The check.
Yes. I received money. That should be the first thing that you're going to recognize, and it's $25. Okay. And then right here, received Robert's payment. Okay. Question number 5 says now on July 15. Okay. Robert files for bankruptcy, and the bank collector basically tells you that he can no longer make his payment anymore. Okay? That the debt can no longer be collected. So what do you need to do?
We need to freeze his account.
You need to refreeze his account again. How do you do it?
Same what we did, like inactive.
Is there, well, how do you do that? What accounts do I need to use?
Account receivable.
And what else?
Now information that under the select
Allowance for doubtful.
Good. For how much now?
we minus 156 minus 1000
$1,031.42.
Good. And once again, to remove Robert's accounts receivable balance. Okay. Number 6. Now it's finally December 31st. Okay, and your company estimates that $252,550.54 of a total of $29,475.72 of accounts receivable are to be uncollectible. Okay, including Robert's debt. Okay, and you have a total credit balance of $157.62 in the allowance for doubtful accounts.
account receivable.
No. Look at the scenario again. It's December 31st. We reach the end of the accounting period.
Okay, close.
Close what?
Okay, allowance for doubtful account.
Okay.
No, is not account receivable.
No.
Okay.
Bad debt.
Yes.
Oh, bad idea.
Because now we reach the end of the accounting period. In this case, do I know exactly who owes me?
Yes, Robert.
So Robert owes you $157?
Oh no, Robert, we own him.
No, he owes me money, not we owe him money. He's our customer.
Yeah, he need to give us money.
Yes, but is he totaling up $2,590?
It was 131.
Okay, so then where's the other $1,000? Where did
Yeah,
that?
we don't know.
We don't know who. Who else owes me money, right? We don't know who. We don't know if Sarah is going to owe me money or not. I mean, it's going to fault her payment or not. We know for sure Robert is done for, but that's only one person that we know. At the end of the day, this estimated is the total amount of all the accounts receivable that you have. So in this case, I have a total of 29,000 people who $29,000 that people owe me, and I figured out that 2,590 of those dollars are not to be collectible, including the $1,000 that Robert didn't pay me. Okay, so in this case, this is an estimated amount. This is an adjustment entry, so you would use the bad debt expense. Okay, now how much am I going to journalize my bad debt expense for?
Is 2,000? 29,000, correct?
That's not your estimated amount. That's your total amount of accounts receivable. You're gonna write it all off?
Okay, 1 second. On December, company 25. Oh, no. Account receivable for employee records. You have total debit balance. We need to got the 175.
Okay, what do we do with that?
Take it from 29.
What do you mean by take it? Oh, not 29, but I mean
25.
25.90. Okay, what do you mean by take it away?
Like we minus it
Why?
because this is how much. Like we need to put it in the debit.
What tells you that you need to subtract?
The credit balance.
Good. So in this case, what is 2,590 minus the $157.62?
Yeah, 2,000. Uh, 2000 24 3 2 9 2.
What? Say that again. 2,400
400 3 2
32
9 2.
92. Okay. Good. All right. 2432.92. Okay. All right. So everything else from here are just examples of doing more bad debt here. Okay. Number 7, okay, if a company estimates that 20,000 of a 500,000 accounts receivable is to be uncollectible, okay, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
Bad debt and allowance for doubtful.
Now, what is the number going to be? What's the amount going to be?
We minus the 5,000 from 20,000
Why minus?
because this is how much we have the balance, debit balance.
Well, you have a debit balance this time.
Oh, we added.
Okay, so in this case,
We're gonna be having 20, 25. Account.
So how much? 25,000?
Yes.
Okay. No worries. All right, question number 8, okay? If a company estimates that 20,000 of its 500,000 total credit sales is to be uncollectible and there's currently a credit balance in the allowance for doubtful accounts for $5,000, right? The adjustment entry will be okay.
So account estimate that 20 for 5 total credit. Okay. Our income is currently a credit balance of 5,000. Okay. Now we're gonna be add again.
No.
No, a minus. Uh,
No. Look at this again. What tells you? Okay, which method are you using? The balance statement or the income statement?
Credit balance of income.
Okay, so if it's the income statement method, then what does the income statement method tell you?
It's we got the 5,000.
No.
Okay.
On the income statement method, do you see the accounts receivable or the allowance for doubtful accounts?
No.
No. If you don't see it on the income statement, then what do you do?
Oh, we have the 20 from 5,000, correct? 50,000. Now we have left 3,000, 30,000.
No. Again,
It's the 25.
not 25. We're not adding. Okay, because in this case, we're looking at the income statement method, which is the total credit sales. In this case, when we look at the total credit sales or the income statement, right, the allowance for doubtful accounts doesn't even appear on it. So in this case, we choose to ignore whatever amount that's in the allowance for doubtful accounts. So what number are we going to be looking at instead?
20.
We're just looking at 20, right? That's it. We don't care what the balance is in the allowance for doubtful accounts because it is total credit sales. It doesn't appear, it doesn't affect the income statement whatsoever. All right. Question number 9. Okay, if a company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, your adjustment entry will be
25.
not 25. You're not adding or subtracting.
15.
20.
It's not 15. So in this case, let's read this carefully again. We're looking at $20,000 worth of total credit sales.
So we got the 25 from 50,
Where are you getting 25?
like 20 with the 5.
Income statement. Does the allowance for doubtful accounts or accounts receivable appear on the income statement?
So we minus the 5,000 from the 20.
You didn't answer my question.
Huh.
Do you see the allowance or the accounts receivable appear on the income statement?
Allowance.
That's not my question. Does it appear? Do you see accounts receivable or allowance for doubtful accounts appear on my income statement?
I see account receivable.
Where do you see accounts receivable on the income statement?
Oh, income statement. Credit sale, cash sale.
No.
So my question I was asking you, do you see the accounts receivable or allowance for doubtful accounts on the income statement?
You want shoes? Put on your shoes. Put on your shoes. Put on your shoes.
No, you don't see that. It doesn't appear on
Come here.
the income statement.
Look. Come on.
So in this case, if it doesn't appear on the income statement, we do not care about the account balance on the allowance or doubtful accounts. Okay? So if we don't care about what this about $5,000 balance is, then what do we care about?
The 20.
Just the 20,000.
So it's gonna be 2020.
Okay? So in this case, right, I even made it in bold. Okay? So here's the difference. This one says total credit sales, right? Let's see what the next one says. If a company estimates that 20,000 of a 500,000 accounts receivable are to be uncollectible, and now there's a current balance of a credit balance of $5,000 in the allowance for doubtful accounts. So in this case, the difference here is I see the word accounts receivable, where the previous one was total credit sales. So in this case, if I'm looking in my question number 10 here, and I'm looking at accounts receivable, which method am I using? I'm using the balance sheet method, right? On my balance sheet, 100%, it's an asset. The accounts receivable is an asset to me. So the balance sheet, right, does the accounting equation asset equal liabilities plus equity, right? So in this case, yes, my accounts receivable does appear on my balance sheet. So therefore, if there's accounts receivable, there's 100% going to be the allowance for doubtful accounts. So in this case, we do care about what the balance is on the allowance for doubtful accounts. Now here's the determining factor. You currently have a credit balance. So what does a credit balance tell you? What does the credit balance of $5,000 tell you?
That will be added.
Not add. You're already on the right side and you need to be more to the right.
So we're going to subtract 25,000 from the 20.
Yes,
So it'll
it'd
be 15,000.
be 15,000. Excellent. Okay. Right? Good. Okay. Any questions on chapter 10.1? Okay.
So now here, when we see it account receivable, we will be like minus the minus, correct?
It depends on what the account balance is in the allowance for doubtful accounts. Right? So here, balance sheet, you're going to look at the estimate, right? You see the words account receivable. If there's currently a debit balance, you're going to add. If it's a credit balance, you subtract. So you have to pay really close attention to this one. Any other questions? We will practice this more again the week you come back, and then we're gonna also practice this again when we study up for the midterm. Okay. All right.